Jai Hind everyone. Welcome to my YouTube channel which is Explore Yourselves, Banking and General Knowledge, etc. Today I'm going to describe about tax on gifts to spouse under Income Tax Act 2025, clubbing provisions and tax planning. Introduction. Gifting money, property, shares, jewelry or other assets between husband and wife is a common practice in India. Such transfers may be made for family support, investment planning, wealth management or financial security. Under the Income Tax Act 2025, gifts received from specified relatives, including a spouse, continue to enjoy tax exemption from the time or at the time of receipt. However, taxpayers must understand that exemption on receiving a gift does not automatically mean exemption on income generated from that gifted asset. The Income Tax Act contains specific clubbing provisions to prevent tax avoidance by transferring assets to a spouse who may have a lower taxable income. These provisions ensure that income rising from such transferred assets is taxed in the hands of the original owner under specified circumstances. Gift received from spouse, is it taxable? Under the Income Tax Act 2025, a gift received by an individual from a spouse is generally not taxable because a spouse falls within the definition of a specified relative. Therefore, if a husband gives money to his wife or a wife gifts asset to her husband, the recipient does not pay tax merely because the gift was received. For example, if Mr. A gives rupees 15 lakh to his wife, Mr. Mrs. A, the rupees 15 lakh received by Mrs. A is not treated as taxable income in her hands. However, the tax treatment changes when Mrs. A invests that money and earns income from it. Understanding clubbing of income provisions. The concept of clubbing of income means including the income of another person in the taxable income of an individual in certain situations. The purpose of these provisions is to stop taxpayers from reducing their tax burden by shifting assets or income to family members without genuine commercial reasons. Under the revised income tax framework, clubbing provisions continue to operate with same basic objective, although the structure and numbering of provisions have been reorganized compared with the earlier Income Tax Act 1961. The methodology of tax impact of clubbing provisions have not been fundamentally changed. Gift to spouse in section 64 concept, where an individual transfers an asset directly or indirectly to his or her spouse without adequate consideration, the income arising from that transfer asset may be included in the income of the transferor. In simple words, gift itself may be tax free. Income from that asset may be taxable in the gifts in the hands of the gift giver. For example, Mr. A gives rupees 20 lakh to his wife. Mrs. A invests the amount in a fixed deposit. Fixed deposit interest earned rupees 1.40 lakh per year. The interest may become may the interest income may be included in Mr. A's taxable income instead of Mrs. A's income because the investment originated from the asset gifted by Mr. A. Example, gift of shares or mutual funds. Suppose a husband gives shares worth rupees 10 lakh to his wife. The wife receives the shares without paying any consideration. Later, she receives dividend income. She sells the shares and earns capital gains. The income arising from such gifted assets may attract clubbing provisions and may be taxable in the hands of the husband, depending on the applicable provisions and facts of the case. The purpose is to prevent shifting investment income to a spouse only for taking advantage of a lower tax slab. Gift of property between husband and wife. Transfer of property between spouses requires careful tax planning. Example, a husband gives a house property to his wife. The wife receives the property as a gift. The gift transaction itself may not create immediate tax liability for her. However, rental income from the property may be considered under clubbing provisions. Future capital gains on sale may require consideration for applicable tax rules relating to the original transfer. Therefore, transferring property only for reducing tax liability may not achieve the desired result. Income generated from income. Important planning point. An important point in clubbing provisions is that normally the first level income generated from the gifted asset may be clubbed with the transferor's income. Example, husband gives rupees 10 lakh to wife. Wife earns rupees 80,000 interest. That rupees 80,000 may be clubbed with husband's income. But if the wife invests that rupees 80,000 interest separately and earns further income from that amount, such secondary income may generally be treated differently depending on the facts and applicable rules. Proper professional advice should be taken for complex situations. Situations where clubbing may not apply. Clubbing provisions generally focus on transfers without adequate consideration. Therefore, certain situations may have different treatment. Examples may include transfer made for adequate consideration, income earned from spouse by their own independent assets, income earned through the spouse's own professional skills or qualifications in applicable situations, genuine commercial arrangements supported by proper documentation. Each case depends on the facts and nature of the transaction. Tax planning for married couples. Effective tax planning does not mean simply transferring assets between spouses. It requires understanding ownership, source of funds, and tax implications. Some important points: maintain proper records of gifts and transfers, keep bank transaction proofs, understanding clubbing provisions for transferring income generating assets, avoid arrangements created only to reduce tax liability, plan investments based on genuine financial goals. A spouse investing from their own independent income generally has a separate tax position. Practical example: Mr. X earns rupees 20 lakh annually. He gives rupees 25 lakhs to his wife. His wife invests this amount and earns rupees 2 lakh interest. Although the wife received the gift without tax, the rupees 2 lakhs interest may be added to Mr. X's taxable income due to clubbing provisions. If the wife invests money earned from her own salary or independent sources, the income may generally remain taxable in her own hands. Conclusion: gifts between spouses are an important part of family financial planning, but taxpayers must understand the difference between a tax free gift and taxable income generated from that gift. The Income Tax Act 2025 continues the principle that transferring assets to a spouse without adequate consideration may result in clubbing of income in the hands of the transferor. Proper planning, documentation, and awareness of rules can help families manage wealth efficiently while remaining compliant with the law. Disclaimer: this article is prepared only for educational and general awareness purposes. Tax laws, sections, rules, interpretations, and procedures may change from time to time. The applicability of clubbing provisions depends on individual facts, source of funds, nature of asset, and transaction structure. Readers should consult a qualified chartered accountant, tax professional, or financial advisor before making significant financial decisions. Thank you very much for your patience. Please like and share this video and subscribe to my YouTube channel.